to make sure that we are on Facebook, LinkedIn, YouTube, and whatever else we're on. I lose track. Twitter, I think. And here we are live. So today, ladies and gentlemen, we are talking about a really important topic that I think has been important for years, but has been neglected until I found today's guest, which is Ben Koch from Accrue, and that's getting investments in an Amazon business without having to sell the entire thing, which is surprisingly rare. So Ben, thank you for coming on live with this and coming on the podcast for us as well.
Yeah, thanks for having me. Excited to be here.
No worries. So if you're watching live or on the replay and any social media channel, obviously the advantage of that of a podcast is you can ask questions or comments. So if it's around the topic, please, not, should I start a retail arbitrage business? That's not relevant to the topic. But if it's about getting investment or fundraising for your FBA business without having to sell the whole thing, then we'd be delighted to hear your thoughts and comments. We can either weave them into the show or we'll try and, wrap them up afterwards as we come across them. So that said, we're going to record a podcast live. So let's get into that right now. Ladles and jelly spoons, welcome back to the 10K Collective podcast, the place to be for 6, 7 and 8-figure Amazon sellers. Today we are talking to Ben Koch, president of Accrue, and they are investors in Amazon sellers and Amazon-based businesses. Simple idea, but one that I think, Ben, is surprisingly rare. So thank you for coming on the show.
Yep, thank you for having me, and I'm excited to be here.
Yeah, good to see you. So tell us a little bit about yourself and Accrue, first of all.
Okay, sure. Yeah, so
I'm so sorry. Carry on.
No worries. So we started Accrue about 3 years ago, and that sort of grew out of some experience that I had selling on Amazon, mostly with what people call the wholesale strategies. So buying name brand products in bulk and reselling them on Amazon. Did that for about 6 years, and then also started a company called Algo Online Retail, which is basically a community of Amazon sellers, mostly in North America. And then 3 years ago, we started Accrue. We made our first few investments just with our own money, with no software, with no real plan, just to see how it would go. And it went pretty well. So I started the business with my twin brother, my dad, and then 2 other business partners who have a pretty diverse background in finance. And I kind of bring the Amazon background and experience. So that's how we got started and how we're here today.
Great. So you got the perfect background. You've got the FBA background. You've also got the background in the investment side. So you've got 2 sides. So what was the thesis then? So, I mean, in a sense, I'm amazed that nobody else has been doing this at scale at the level that we've seen aggregators do this, because it feels to me less risky to buy part of a business and multiple businesses than buy an entire business. And yet I've rarely seen this. So why do you think it's not been done? And, what got you guys to do it in? I guess it's 2 questions in one.
Yeah, so I think as far as the aggregators go, I think they have, on paper, it sounds like a very good idea to buy all of these businesses, but I think a lot of the bigger ones didn't necessarily have the operational experience, and the ones that do have the operation experience are usually smaller. And even then, it's a lot different running 1 or 2 Amazon businesses than 50 combined Amazon businesses. And for us, we looked at really more at what people were doing investing in Amazon businesses. So there were a lot of loans out there that the terms were probably not the most favorable for Amazon sellers and didn't really help them grow that much. So we said, well, how can we fund Amazon sellers, help them grow quickly, make a good return for ourselves, but actually help them and not, hurt them and be predatory towards them. So sort of running through a whole bunch of numbers, and with my background in Amazon and telling my other partners that, hey, a lot of Amazon sellers are making, 5, 10, 15, 20% per month on their investment. And we said, well, maybe we should just invest in them sort of like an equity share and earn a part of that profit. And then rather than making them pay us back, say, keep reinvesting our money and growing as fast as you can and as big as you can, and then pay us back whenever it makes sense for you. So that's sort of how we came up with everything. And the goal was, we don't know better than an Amazon seller who's built their business. Let them continue to run their business and do a good job with it. And we'll just find the good ones and give them the capital they need to grow.
Yeah, that's very smart, actually. It's a bit like the third-party thesis that Amazon had, which turned out to be an absolute winner, which is, being the first-party seller means you're doing everything yourself and you're taking all the risk. Whereas if you're investing in other people who are proven to be competent, then you're letting them do the operational work that they've already shown expertise in, right? And that's very scalable, it seems to me as well. I mean, I presume you guys have invested in quite a few different businesses now.
Yeah, so we invest in pretty much everything across. So we have retail arbitrage sellers that we're invested in, some actually like pretty big ones doing millions of dollars a year, wholesale model, private label, and then all the kind of variations in between. And for us, we just keep an eye on the numbers and make sure some key metrics are met and let the seller do whatever they want. And for the most part, it works out pretty well. And it's a lot less headache for us than having to deal with sourcing and account management and PPC like an aggregator would for
Oh yeah. Oh yeah. How much? I mean, every single Amazon seller who's ever dealt with this stuff for 5 minutes knows how much of a pain it is just for one business. So, and speaking to the aggregators of the last couple of years, where there was a sort of a trickle, then a surge, and now a trickle again of people coming on the podcast. I mean, the headaches they've had with integrating this stuff, as you said, running 58 the same as running one, and if you've run none, then that's even worse. So tell me about the key metrics then. So this is, I guess, edging into the question of how, if somebody's interested in a tactic investing like yourselves, um, then, how do they make themselves investable? What are those key metrics that you do actually have to see?
So we look at a few things. One would basically be the size of like their asset pool, right? So there's a lot of people selling on Amazon who have, a couple hundred or a couple $1,000s invested in their business. And for us, that's more of like a side hustle. It's not really an investable business. So what we're really looking for is that they have at least, let's say, $10,000 invested in their business in either inventory or, an Amazon receivable coming in that they're going to turn into inventory. So basically at least 10,000 in assets, ideally more than that. And then the big thing that they're profitable and that they're earning a decent return on their investment. So what we've sort of seen is, right, if you have $10,000 in assets, the ideal Amazon business, or even 100,000, let's say, to keep the numbers more interesting. If you have $100,000 in assets, $100,000 in inventory, we want to see you generating somewhere around $10,000 a month in profit. And that's what we've sort of seen across the better sellers we're invested in all the different models. So private label, they'll buy more inventory. It takes longer to sell out. Retail arbitrage and wholesale, they'll turn their inventory quicker, but at a lower profit per sale. But in general, making around 10% on your money every single month is sort of the ideal profit metric. If it's a little bit less or a little bit more, we can still invest in you and work with you. But that's sort of like a target across all the different models and pretty much every size of what you kind of want to be shooting for your return on investment. So if you take your assets, you have 10,000 in inventory, you really want to be making at least $1,000 in profit every month.
Yeah, and that's a very good sanity check as to whether your business is investable. I always say to people that I've always encouraged people to talk to business brokers and aggregators. And now I'd encourage everyone listening who's relevant for, we ought to talk about that in a sec, to talk to you guys, because if an external investor won't invest or a lender won't lend, that's a red flag for me that your business, or at least an amber flag that your business may need, looking at from your own personal perspective. If 80 or 90% of the equity is your own, if you're the business owner operator. Anyway, so my little preach over get in touch with investors just for educational purposes, if nothing else. By the way, we'll talk about that. So who do you actually serve out there? Is it only people who sell in America? Is it only American-based businesses? What's your sort of people that you can actually work with?
So right now we only invest in people selling on Amazon.com, so the US marketplace with FBA. We're expanding that to other marketplaces and other marketplaces and other countries with Amazon. But we invest in people from all over the world. So we have sellers in Europe, Mexico, Asia, all over the world. But if they're selling on Amazon.com, the biggest Amazon marketplace, we can invest in them.
Great. That's just worth clarifying in case somebody's getting excited and thinking I must get in touch with Ben. Lots of people, by the way, that I work with in the UK do sell in America. So that's yet another reason to sell in America, in my opinion, because the investment and lending pool is just bigger, in my experience. And you're an example of that. So tell me a little bit more about the profit trends. You were saying that, interestingly enough, this sort of, you're able to get the same sort of return on investment from private label models as well as retail arb models, because the profit level but the turnover of stock sort of balances back out. Very, very interesting. So what other sort of trends are you seeing out there in terms of profitability of Amazon businesses, in particularly the sort of current challenges we've got with supply chain costs going up and then a potential recession that everyone's talking about? How's that all panning out so far?
Yeah, so I think a few trends. It seems like there are, well, first of all, there was the whole issue with supply chains that seems to have sort of been taken care of over the last few months. It seems to have really gone back to normal. Prices are going down, shipping times are getting faster. A lot of the sellers we work with are using AGL, Amazon Global Logistics, which has been pretty quick and pretty reasonably priced for shipping products in from China. So obviously with shipping, that's kind of been the trend, is things going back to normal. Some of the other trends that we've seen a lot of, there are a lot of people that I would say are maybe upside down, where they've taken on a bunch of debt and not really paid attention to, am I profitable? Is this debt going to help me make more profit? And they've sort of taken on debt and now making those loan payments, plus running their business maybe at a small loss, have sort of put them on a downward spiral where their business isn't doing so well. A lot of US based sellers took on big loans from the SBA, the Small Business Administration in the US during COVID, because they were easy to get and they're much bigger than their asset pool or the size of their business. So let's say, there's a lot of sellers out there, maybe have $50,000 in assets and are making $5,000 a month in profit, and they got a $200,000 loan from the SBA, and they're small payments, and they're due in 10 years or something like that. But there's no way they don't really have a clear path to ever pay that back, which is starting to kind of become a realization for a lot of them now.
Yeah, I
Um,
bet. That sounds pretty. Let's talk about that for a second, because that sounds like a really important question of how to deal with debt safely. I mean, it's a huge topic, but have you got a sort of metric that you would use for that? Is a sort of percentage of a loan to equity ratio, or what other? How do you deal with that safety issue of debt?
Yeah. So, I mean, we always just look for people not to be upside down, right? So if you have $50,000 in assets in your business, you don't really want to have more than 50,000 in debt. And if you're borrowing, let's say 50,000, you want to use that money wisely, ideally to invest in more profitable inventory that's going to make money for you. Rather than what a lot of Amazon sellers do is say, oh, I lost, $5,000 this month and I'm going to lose $5,000 next month. How do I cover that loss? Oh, let me go borrow money to cover it. And when you're borrowing to cover a loss, you basically just are digging yourself into a deeper hole, which seems like a lot of Amazon sellers end up doing. So that's how you end up basically ending up upside down, right? Because you're losing $5,000 a month. You just borrowed 50,000 to basically cover those losses for the next 10 months. And at the end of it, now you owe 50,000 and you still only have 50,000 in assets. So, and then they basically throw away all their equity. And that happens like all the time. We see tons of businesses, especially even larger ones, like guys who are doing $1 million plus a year, where they took on a lot of debt to grow or to cover their burn, basically, so that they could spend more on PPC and try to grow faster. And now they're realizing, well, I have, 100,000 in assets and I owe 150 from all the money I borrowed. How am I going to pay this back? And, they're just upside down. And that's actually, I think, become more common recently than it has been in the past. And I think
Yeah.
part of it is just the availability of money.
Right, it's interesting, isn't it? I mean, I've seen. I remember speaking to a guy I worked with in a different industry once, who knew some club owners, some football club owners in the UK, so soccer as you call it. But the Premiership is huge money, not quite as big as American football. And there's one guy who was worth £60 million, whatever that is. It's like $61 million, the way the exchange rate's going, depending when you listen to this. Um, Sadly, not a joke, probably. But anyway, he ended up worth minus £15 million. And I think you need to be making a certain amount of revenue and be very lendable to really get yourself into a hole, right? And that's one of the dangers, is when the lending market is easy and you've got enough to be lendable for short term, you can really get yourself into trouble. Or to put it to quote Jeff Goldblum from what is it? The movie about dinosaurs whose name escapes me. Just because you could doesn't mean you should. All that to say that one has to be careful with loans. And just to cap that off, just spell out for me, what does upside down mean? Does it simply mean that you've got more debt than equity, or is it the cash flow monthly, or what do you mean by that?
Yeah. So we basically just say upside down. It would be more debt than your assets, right? So maybe you have $50,000 worth of inventory and a $10,000 Amazon receivable. So you have $60,000 in assets, or, maybe some cash in the bank too. And then your debt is maybe 70,000. So you owe more than you have in assets. And if if it's a small amount and you're running a profitable business, you can close that gap. But a lot of people who end up in those situations have that gap because they're not running a profitable business, and it's almost impossible to close that gap. And it just basically keeps getting bigger and bigger.
Yeah, that makes sense. Okay, so it's essentially about the assets to debt ratio, but it's also about the cash flow and can you ever pay that debt off? It's a frightening question. So what other trends, just quickly, are you seeing out there around money? Let's talk about money and particularly profits.
Mhm. Yeah, so I think maybe one of the biggest trends is there's a lot of sellers that don't really know if they are profitable. Maybe they're tracking thing. Everybody sort of has their own way of tracking things. Some of them use tools to track their profitability. Some of them are looking at their profitability on a per unit basis instead of a company-wide basis. Um, and then I think a lot of them, when it comes to ROI, are thinking of ROI just on a product basis, right? So I make a return on investment. My product has 100% ROI, and they don't really consider that that's it's going to take them a year to sell out of their inventory and restock. So yeah, they made 100% ROI, but it's over a year. Whereas some of the resellers, they can turn their stuff every month and they're making 10%. And if you compound that over a year, they're going to do better than the private label guy who has a year's worth of inventory that's going to take a year to sell it. And then I think another big trend that we've just been seeing is there is a ton of money out there, especially for people selling on Amazon.com. There's just a lot of money out there that's available. And I think a lot of people take on that money. And like you were saying, either they're not profitable and they're taking that money and basically digging themselves into a deeper hole, or they're not fully understanding the terms of the investments that they're taking. And they basically end up with a surprise bill at the end, or in some cases, the next day when somebody sucks that money out of their Amazon account, and they have to start paying it back. So there's a lot of money out there with a lot of very different terms that are kind of all over the place. And I think that somebody who's thinking about taking on investment, number one, needs to make sure they're profitable and they have a plan to profitably deploy the capital they take on. And then number two, make sure that they understand the true difference between all of the funding options out there, because we've seen just a lot of people get in trouble, even if they had an okay business generating some profit, that now, they took on some really complicated financing structure that they don't understand. And they're basically taking all of their Amazon receivable every month and sending it off to a lender. So I think those are probably some of the key trends that we've been seeing out there.
Yeah, very wise. And again, it comes down to that basic thing that I used to have a business coach who was obsessed with marketing, and I sort of have come back around to checking out what he's doing in the last few years, and it's all about the numbers, which is interesting. I think that seems to be a trend that I see with business owners, that you get excited about the revenue potential, and of course you've got to have that, and that's very much a startup obsession, right? But when you get to a certain point, you have to obsess about how the cash is flowing, is it flowing, and which direction, of course, and then where's the profit, or is there any? And it's, as you say, it's quite a surprisingly high number of people that get quite far with this business before they get those numbers clear. So this is another call for clarity around numbers, really. Well, look, this is great stuff. What services do you offer? We've already mentioned that you will work with anyone who's got an Amazon.com account, which is quite broad. Who else any other sort of criteria for who you work with and how you help them?
No, I mean, that's really it. So if, they have at least $10,000 or so in assets, which usually equates to somewhere around $10,000 in sales, they're selling on Amazon.com using FBA. And they're profitable. We can invest either, $10,000 to $1 million in their business. And the thing that we kind of do that's unique was, in looking at this, right, most of the funding options out there make you repay them very quickly. They're basically based on your cash flow. That's what the investor feels comfortable investing against. But with Accrue, we basically let you pay us whenever you want. So we have people that we've invested in years ago who haven't paid us a single penny yet. And the way that we do that is we just track, our share of the profit and what's happening with the business in our proprietary software portal. And we see how the business is performing, and we're comfortable basically saying, keep everything in there and keep rolling the money over. We'll make more money. You'll make more money. Everyone will grow faster, and it's better for everyone. So I think that's probably the big difference in how we help Amazon sellers. We say, don't send us. We don't want you to send us money. We want you to keep taking that money, buying profitable inventory, and turning it over as many times as you can. So yeah, that's how we help Amazon sellers. We'll invest in them and let them run with it.
Amazing. So I think the place to go, correct me if I get this wrong, app.accrueme, ACCRUEME.com. That's app.accrueme.com to connect to you guys and have a chat about it. Is that right?
Yep, exactly. app.accrue.com. Tell us a little bit about your business. You connect us to your Amazon store. We basically generate a whole big report on how your business is doing, and we'll give you an investment offer, or you can talk to someone on the phone if you'd like. And hopefully we can get you funded in a couple of days if that's how quickly you want to move.
Amazing. Well, I would encourage anyone who this is a possibility for not to waste Ben and his team's time, but if it's a possibility that you're serious about, not to be afraid to talk to a potential investor, because if nothing else, you're going to get educated quickly about whether your business is investable. And it's a bit of a harsh reality check, but I think it's an important one to go past external eyes to your business. So for all those reasons, and you're obviously incredibly competent about assessing viability of Amazon businesses, a great thing to do. So app.accrueme.com. Ben, it's great to talk to you. We're going to come back to you in a short episode to talk about different types of capital raising, and which is an interesting thing to make sure we understand and wrap our heads around. But for the moment, big thank you for opening our eyes to the possibility that you guys are offering people.
Yeah, thank you for having me. This was fun. Thank you.
Great, and that's the first episode done, folks. Again, don't forget, if you have any questions to pop in, if you're with us live. I don't see any comments or questions so far, so we're going to plunge on to our second episode. If you're good to go, Ben.
I'm good.
Here we go then. Let's do this thing. Okay. Ladies and gentlemen, welcome back to the 10K Collective podcast, the place to be for 6, 7, and 8-figure Amazon sellers. I'm here with Ben Ktocha from Accrue, and they are investors in Amazon sellers. And amazingly, unlike the aggregators we've heard so much about, they invest in a percentage of the business. They don't buy the whole business, and they don't demand that you pay the money back the next day either. So that's a refreshing change. So Ben, welcome back to the show.
Thank you for having me, Michael. Glad to be here.
Yeah, we've certainly educated myself a great deal in the last episode about your way of looking at the finances. So really helpful. If you haven't listened to that, folks, do listen to that. Today, we're going to talk about a quick comparison of different types of capital raising. So there's loans, I guess, and there's equity, right? Or what they call dilutive funding, I believe. This is the phrase I've heard. So is that about right? What is the sort of simplest way of dividing this world up?
Yeah, so there's, I guess, debt and equity is probably the highest level, simplest form. And then I sort of like to think of it also in tiers. So like based on your size and business performance, you can be eligible for different tiers and levels of funding. The smaller and newer you are, the more expensive and smaller the lending or investment amounts are going to be. And the bigger you are, the more options you have available to you. So kind of going through, the top options for Amazon sellers. So the first one is just starting with like family and friends. So if you're brand new, you just have an idea and you're just starting an Amazon business, most people are going to either have their personal savings to dip into, but if they don't, they're either going to turn to family and friends and say, hey, can you invest and help me start this business, or credit cards. So both obviously not ideal or not the most popular type of funding, family and friends, because if things go well or even, or don't go well, you're going to have to spend some time with your investors at Christmas and all the holidays and explain to them what's happening with your business. And then credit cards, obviously people don't like, because they have an impact on your credit score. And this obviously depends on where you're based, personal guarantees, high interest rates, all that kind of stuff. So that's basically, if you're just starting out and those are really your only options. Then once you have a little bit of an Amazon business going and you're making some money with it and you're generating revenues, not necessarily profits, you can get into factoring and revenue-based loans. So factoring is basically when a company will buy your Amazon receivable. So let's say Amazon owes you $100,000. They'll say, well, I'll give you 90 today. And when Amazon pays you the 100 in, the 100,000 in 2 weeks, we'll take 95 and send you the other 5. So you got 95 and we made a small cut of your receivable. That's a pretty low risk investment for the investor. And for Amazon sellers, I kind of compare those two are like payday loans, right? Like I get paid on Friday and I need the money on Monday for rent. So let me borrow against what I'm getting paid. So those are going to be expensive. And basically it becomes a cycle where you're going to have to constantly keep doing that. Basically constantly keep borrowing against your receivables to stay afloat. So it's good if, you need money tomorrow and you don't have any other options, but it's expensive and it's kind of just starts you on a cycle of constantly having to borrow against your receivables. Then a little bit higher up, there would be revenue-based loans. So revenue-based loans is where investor is going to look at your business as a whole, and then mostly looking at your revenue, and they'll lend you money and basically say, for every sale you make, I want 20% of your proceeds, right? So maybe you're doing 100,000 sales a month, and they say, of that, I'm going to take 20 off the top. You're going to pay that back to me to pay down your loan, and we're going to do that until the loan gets paid back. Those are pretty popular now, the revenue-based ones. There's a lot of companies offering revenue-based financing. The thing that a lot of people get stuck with is if they're not making a 20% profit on their sales, and they're paying 20% of their revenue to pay back the lender, they're basically, upside down at that point with their cash flow, and they're going to need to keep borrowing to sustain their cash flow, buy more inventory, and that again, kind of gets them into a little bit of a hole. And then there are term loans. So those are things like what's offered by Amazon Lending. Those are probably, as far as loans go, the best option for Amazon sellers, depending on the terms you get. So Amazon loans can vary pretty wide as far as terms go, right? They can give you a 3-month term and 15% interest, or they can give you a 16-month term and 10% interest. And that term, the amount of months that you have to pay the loan back, is going to have a really big impact on your cash flow. For example, if you have $100,000 and you need to pay it back in 3 months, if you have a 3-month term, you're basically paying $30,000 a month back to Amazon. Whereas if you have 12 months to pay it back, you're paying less than $10,000 a month. So it makes a big difference on your cash flow, the term that you have. And then the other one would really be equity of some sort. So bringing in an equity investor. There are all kinds of people who could be equity investors. It could be family, it could be friends, it could really be anyone. But equity is probably an option either with family or friends, or you have to be very big to be attracting a professional type investor, or even an aggregator that's going to do a partial buyout or something like that. And then I guess there's also Accrue. So technically we are a preferred equity investment in your business, but we're a temporary equity investor in your business, meaning once we get back the amount of money we've invested, plus our share of the profit over time that we track in our portal and you can see every day, we give back all the equity that we have in your business. So those are the kind of full rundown of all the different options out there for funding your business.
Great. Well, I'm taking very detailed notes here because there's a lot to absorb. So as ever, if you want to read the notes, folks, to go to 10kcollective.com, and we make notes and put our links there. So the obvious question for me then is with Accrue, that a preferred equity investment. Okay, you get back what you invested plus your percentage of the profit, as is presumably relative, if that's the right word, to the amount you invested, the percentage of equity you have. But how do you actually get that back? Is the idea, what's the exit strategy, if that's the right word even? Is it that everyone will sell the business and you get paid back then? Or is it more normal that the majority business owners will buy you out over time? How does that actually look in practice?
So what most of them have done is they end up, some of them sell and just pay us off when they sell. And then a lot of the times what happens is, we give them money, they grow very quickly. And then they start running out of things to do with the money. So, they used to say, I have more product opportunities than I do money. I need more money so I can buy more inventory. And then it gets to a point where they say, I have as much inventory as I need and I can't find more products, or, I don't have, I have 6 months worth of all my SKUs. I don't need to keep paying you guys. I have enough money to basically support the business on my own. And what they'll usually do in that case is then start paying us down slowly or pay us down in one big chunk. So, we can let them, a lot of people use our funding sort of like a credit line where they'll draw down money from us when they need it. And they can do that all in the portal, can you click a button, send me more money, or they pay us back when they don't need it. So they'll say, hey, I have an extra 10,000 sitting in the account and I don't have anything to buy with it right now. So you guys take that back. And they just click a button, we take it back. And then if they ever need it again, they draw it down. So that's sort of how most of the people who have paid us back in full have done it. They basically said, I got an extra 20,000 this month, take that. And then the next month, same thing. But it's all on their schedule. And if they needed it, they know they could always pull it down. And some of them, have just sold and said, hey, I'm selling, I'll send you, a big check tomorrow. But for the most part, it's been slowly paying us down over time on a schedule that works for them.
Yeah, great. So it sounds like you have a lot of the advantages for the seller anyway of the, sort of more flexible but more expensive loans. But of course, the cash flow is very different because you're not asking for the money tomorrow. So that does sound pretty ideal, I have to say. So let's talk about the simple thing of investments versus loans. I mean, again, simple. This is a huge area, I realize. But if you could sum it up in a nutshell, what is the best use of loans? We've talked about in the previous episode how people get it wrong. So over borrowing relative to their equity by the sound of it, or if you explained that, if you're making less than 20% profit and you've got to pay 20% of your revenue back each month, obviously you're going to end up in a big hole, right? So we've explored that. But in the positive use of loans, what's a good use of loan and what's a bad use of equity and a good use of equity?
Mhm. Yeah. So if you have a loan, if you have a short-term need for cash, then a short-term loan makes sense, right? So we talked about like factoring, which is kind of like a payday situation. But for example, if you have inventory sitting in customs or sitting at the port and your supplier won't release it until they get paid, and you have a big Amazon receivable that you'll receive in 2 weeks, but you need the money today to release the shipment, then something like factoring would make sense for you. For a traditional type of loan, as long as the payment term is long enough and you're profitable, a traditional loan makes sense, right? So, if you're only paying if you have $100,000 loan and you're only paying $5,000 a month because it's a 2-year loan and you have that money working for you, making more money than it's costing you, a loan like that makes sense. Where people get into trouble, like we said, is with the big payback amounts, or if they're not profitable and they have a loan, things like that. And then for equity makes sense when you where a loan would be too expensive for you, or an equity expense as far as the interest rate, which really isn't that important in a lot of cases. People always focus on interest rate because like that's what they've been trained to focus on. But I think for Amazon sellers and for Amazon loans particularly, the most important thing really for them to be focusing on is the payback terms, because you could get a $100,000 loan where you have to pay it back in 60 days. And that's very different than a $100,000 loan where you have 2 years to pay it back. The difference is, like basically $25,000 a month in cash flow going to pay a loan or not to pay a loan. And no one really ever thinks about that. I think it's because people are trained, traditionally to think about it almost like, you're comparing mortgages and it's basically everything's the same. It's just what has a better rate. And it's not really like that with Amazon funding. So just back to your original question, loans make sense if you're making money and they're actually, long-term, low monthly payment, reasonable interest rate, reasonable fee loans. And then equity makes sense really just depending on the terms and how it's going to help you grow your business. You don't want to give up a big chunk of your company early on, especially if you can afford to keep growing, or you can get a loan to do that. So equity, they both sort of have their pros and cons, and you, especially in the Amazon space, you need to make sure that you understand actually what you're getting into, and not just shop based on rate or based on the term or the name of the lender.
Very interesting. Yeah. So you're saying that the apparently important number, the interest rate, which of course affects your profit after I suppose after the operating profit, it's the finance profit or loss, right? But on a profit and loss account, it looks really important. But I guess what you're saying is it's all about the cash flow, and that makes total sense to me. And that's why I try and sort of, when I'm working with anyone, sort of in the new early-ish stages transitioning towards that $10,000-$20,000 a month stage, I say, look, never mind the obscurities of the profit and loss account. That's for your accountant. You need to assess about cash flow from day one, because I've seen too many businesses go down from that. So yeah, I'm 100% with you on that. Tell me a bit about more. You say equity makes sense depending on the terms. Could you give us an example of how that might work for when equity would make sense?
Yeah. So, and then just to clarify too, so for Accrue, our equity is a little bit different because you can basically buy us out whenever you want. So we're never a permanent equity investor. We're a temporary equity investor. But for permanent equity, right, for selling a piece of your business, it would really make sense when a loan doesn't make sense, basically, right? You can't get a loan that has a long enough term that's going to make sense for the cash flow of your business. And it also makes sense when you're getting a good deal, right? So maybe you think your business today is worth $1 million and you can get equity from someone and value your business at $3 million. then that might be something you want to consider, basically the arbitrage between what you think your business is worth and what someone's offering you. But for Amazon sellers, right, other than there's a lot of financing options out there, especially as you get bigger, right? Like once you're doing $1 million a year in sales, there's a pretty wide range of different loan options out there for you. So equity wouldn't really make that much sense for you at that point, unless that's your only option, right? Unless you don't have good loan terms, or maybe you're located in a place, your business is operating in a place where there aren't any lenders interested or any specialty lenders interested, then equity is kind of your option. And then the same thing, right, when you're starting, if you're going to a family and friends and saying, hey, I need some money to start my business, equity might be a much better option than debt with them, because that way you don't have to make payments. You don't have to make any payments, sort of like with Accrue. And you just have somebody else in the boat with you, which a lot of people actually like about working with Accrue is that, we do have a lot of experience with Amazon and e-commerce and finance. And when they work with us, technically, for at least the part of time that they are working with us, we are equity investors in their business.
Yeah, interesting about the structure of what you approach family with. It's not just money; it's an investment versus loan. I find an awful lot of people are very vague about that, and I find that makes me, my flesh creep with dread for their future family relationships. Never mind their Amazon business, right? As you say, you've got to have Christmas dinner or Thanksgiving in the US with your investors. If you have investment from family. So yeah, I would say that's not my preferred route ever, but can work. I've seen it go well. I've seen it go badly. So look, this is great stuff. Just remind us what services you offer. You told us in the previous episode, but for those who haven't heard that, obviously you said you're not a permanent investor, but it's some more temporary. Tell us about that. How does that work?
Yeah. So we invest $10,000 to $1 million in Amazon.com. So the US marketplace, FBA sellers, they can be based anywhere in the world, but have to be selling on the US marketplace. And we invest with a temporary equity. So we're investing in temporary preferred equity. And basically how it works is we have a portal where we track the profit, and that's the true profit, right? That's your sales minus your cost of goods sold, minus all of your Amazon fees, minus your Amazon PPC. The bottom line after that, we track your profit. We earn a share of that profit every month relative to how much we have invested and how much the total asset pool of the business is. And then basically what we do is every month we say, okay, this was our share of the profit. Let's write it down, and you go take it and reinvest it in more profitable products. You can pay us whenever you want. You don't have to pay us on any fixed schedule. And we have a lot of sellers that we work with who haven't paid us a single penny for months or even years. And that allows them to just reinvest all of their business in growth. We track it all in the portal. And then someday, they make the decision to pay us back. And when they do pay us back, we lose all of our equity, all of our rights, and we just basically get back what we invested and our share of the profit that was tracked to date. So that's how it works. And if you want to learn more about it and get an investment proposal and kind of go through the details or talk to someone, you can just go over to app.accrue.com and answer a few questions about your business, and then get an investment proposal or talk to someone on our team.
Amazing. Well, look, I would encourage anyone who thinks that their situation matches what you're offering. A lot of people I know, even the ones based in the UK, sell on Amazon.com, and it's definitely a place that you should consider. If you're not yet, then I would encourage you to go talk to Ben, because you're going to learn so much, even if you don't end up taking an equity, because it doesn't make sense. And it does feel to me that this temporary preferred equity, which is another exotic financial term I haven't come across yet. I'm getting educated over the years with the podcast. But that's a new one on me. But it does feel very similar to a loan, in that once it's done, you're out of the picture and you get your company back, which is really amazing compared to traditional equity. So it's definitely a very, very interesting. And as I say, it's something I've been personally considering. How can I engineer this for my clients for years? Because I live in London. I live near the city of London, but I don't have the financial nous to know how to set that up. So really great service you're providing to the community. I really think so. But is there anything else that I didn't ask you, Ben, that I should have asked you about?
No, I think that's it. I think you really hit the nail on the head. For us, we try to take the best of both worlds, right? Take equity with no payment requirements, no fixed payment requirements. We only make a profit if the seller's making an actual profit, not just pulling it off their top line revenue. But then, we're not permanent equity. So as soon as you pay us back, we stop earning a share of the profit, and, we go our separate ways and part friends. And it's worked out really well. We've helped a lot of sellers grow exponentially, and we're just looking forward to helping more sellers grow. The more money they make, the more money we make, and we're kind of in it together with the sellers we invest in, and that's part of the fun.
Yeah, I have to say I really like the structure. I've got to say so. Very impressed. Well, look, Ben, I know you've got to get on to another meeting. It's been very, very educational, if nothing else. And I think for quite a lot of people out there that I personally can think of off the top of my head, this would be a very good option to explore. So if you want to get in touch with Ben and his team, folks, again, it's app. Just remind us, Ben, of the URL.
App. Yep. So it's app.accrueme.com, or you could just go to accrueme.com, ACCRUEME.com.
Exactly. I was going to spell that out. Accrue, one of those awkward words. Has it got an E in it? Yes, it has. So, Ben, very many thanks for coming on the show. It's been educational and very, very interesting. Quick whistle-stop tour through all those funding options out there. Many, many thanks.
Mm-hmm. All right. Thank you, Michael. Have a good weekend. Feel it.
Sorry, cut you off. Wishing everyone a good weekend. Very rude of me. Sorry.
Nope.
Anyone else listening to the live, or if you're on the replay now, I guess then do pop any questions about funding an Amazon-based business, and for Ben, or if I catch them, I'll try and catch Ben and get him to respond. Meantime, Ben, we better let you go. You're a busy man. Fascinating stuff. Thank you so much for sharing that. Really, I personally feel very educated. That I've learned several key distinctions. I think for me, the one thing I'm taking away is the difference again between profit and loss, and never mind the interest rate. It's the cash flow of the loan and the structure of the deal, whether it's equity or loan. So that's the thing I'm taking away. And if you're listening live or on the replay, you might want to think, what is the takeaway you've taken from this? So try and always take something away from this stuff. Ben, many, many thanks for coming on the show.